What's going on, everyone? It's Mick here from Cloud9 Trades, and today we're going to be going over my support and resistance tutorial. So support and resistance, they might be considered basic, but take my word for it and test it yourself. They're also some of the strongest and most reliable tools you'll ever use in your trading journey. So what exactly are support and resistance? Well, let's break it down. Support is like the floor of a house. It's where the price tends to stop falling and bounce back up. Buyers dominate at these levels, creating demand. Resistance is like the ceiling. It's where the price tends to stop rising and pull back down. Sellers step in here, creating supply. And then we also have what's called an SR flip. So once the support level is broken, it often turns into resistance and vice versa. Why are they important? Well, support and resistance levels work because they're based on human psychology and market dynamics. Think about it, right? When traders see price bounce off a certain level multiple times, they naturally build confidence that this level will hold again. This creates a kind of self-fulfilling prophecy. Big institutions also base their strategies around these levels, which adds even more weight to them. But remember, the more times a level is tested, the weaker it becomes. Each bounce off a level consumes the buying or selling pressure at that zone, and eventually it gets exhausted, making it easier for the price to break through. Now let's talk about how to actually find these levels. First, you want to start with the higher time frames. Always start your analysis on the monthly, weekly, and daily time frames. These give you the clearest and strongest levels because they reflect longer term trends. Next, look for reactions. Identify areas with significant bounces or reversals. And then you want to look for zones, not exact prices. Support and resistance are rarely precise lines. They're better thought of as zones where price reacts. Use tools like rectangles to mark these zones in your chart. And then you can spot historical reactions. Check to see where prices reacted strongly in the past. These are your key support and resistance zones as well. Look for areas with multiple touches, significant reversals, consolidation, and volume spikes. Now, support and resistance aren't always horizontal. They can also be dynamic, moving with the trend. That's where trend lines come in. A trend line needs at least 2 touches to exist. The third touch is speculative, but if it holds, it confirms the trend line. In an uptrend, trend lines act as rising support, and in a downtrend, they act as falling resistance. Dynamic support and resistance also show up in moving averages, which can act as guideposts for trends. For example, the 200-day SMA, the simple moving average, is a favorite among traders, and they act as strong dynamic support or resistance levels. And here's how you can use support and resistance in your trading strategy. First, you can use them in entry and exit points, so you can enter long trades near support, enter short trades near resistance, and you can exit trades at the next key level or take a partial take profit. And you can also use them when you look at breakouts and retests. So a breakout occurs when the price closes strongly above resistance or below support. And what you can do is wait for a retest of the broken level before entering to avoid getting caught in fake outs. Now here are some additional tips. Always combine tools, so add indicators like the RSI or MACD for confirmation, and you can also use things like the Fibonacci retracement levels to align with key levels for added confluence. Always align these levels across different time frames. A daily support, remember, holds more weight than a 15-minute support. Practice patience, as it is key. Let the price come to your levels and avoid chasing trades and stick to your plan. Don't make the mistake of overloading your chart. Mark only the most significant levels to keep your analysis clean and actionable. The cleaner your chart, the easier it is to trade in my experience because there's less clutter and we can avoid putting too much focus on the less significant levels. Now, before we wrap up, here are a few mistakes to watch out for. Forcing levels. Keep in mind, not every price movement creates a significant support or resistance. Be selective. Ignoring the context. Always analyze levels in the context of the overall trend. A level in a strong uptrend may act differently than in a downtrend. Skipping the higher time frames. Smaller time frames can create noise. Always start big and work your way down. And now to summarize, support and resistance are very key in trading. They're easy to understand, simple to apply, and incredibly effective when used correctly. Remember, all trades start with these levels, and mastering them will give you a huge edge in the markets. Always start with the higher time frames. Always use support and resistance to plan your trades and manage your risk, and of course combine with other tools and levels to increase the probability of your trade working out. And that's it for support and resistance. If you found this helpful, give it a thumbs up and subscribe for more trading tips. and let me know in the comments how you use trade support and resistance in your strategy. I also have some free trading bonuses and the link to my free Discord in the caption, so check that out. And in my next video, I'll be doing a TradingView tutorial, and I'll show you how to effectively use it to plan your trades. So thanks for watching this support and resistance tutorial, and thanks for your support as always. I'll see you in the next video. Take care. Cheers.